What is up, guys? Welcome to this episode of WuBlockchain podcast, where we dive deep into the world of crypto and try our best to bring you the most independent research and insightful perspectives. Today, we're exploring DeFi with a focus on institutional adoption. With us is Lucas, the head of research at Into the Block, an analytical platform tailored for institutional investors in DeFi. Lucas, it's great to have you here.
Hey Chang, thanks for having me. I can give a bit more intro about Into the Block, which I know you described as a institutional analytics platform, but it's a lot more. So I don't know if you want to start there or
Sure.
maybe like some background as well.
Yeah, I was going to ask about, your background and perhaps share with us a background of, how you got into DeFi. And yeah, I saw I saw into the blog on the description on your website. So that sounds like I borrowed it
Hmm.
there. But yeah, feel free to go a bit deeper.
Of course. Yeah, happy to. So I've been Into the Block since late 2019. We started initially as a generalized analytics platform. I was the first hire for the research team. And essentially, we developed that business for a couple of years, but a lot of us were deep in the early DeFi cohort. I've been using DeFi since 2019 as well. It was very incipient ecosystem back then. And sort of as started getting some traction in 2020, we started seeing this as an opportunity to get involved. Our CEO, Jesus Rodriguez, also has a background in financial industry, working at DRW, one of the largest hedge funds. And so we saw this infrastructure as a new stack, completely different to the traditional finance stack with a different set of risks. And we realized that the traditional institutions would have a harder time transitioning to the DeFi stack than to something like trading in Binance or options or futures in CME. And we still saw that DeFi was very innovative, even back then with the early Compound V2, Maker, Synthetics. Those were essentially like 20 protocols live or before DeFi summer. And then, of course, DeFi summer happened and it started accelerating. And we started playing around individually with a lot of those strategies that many people here partook on, like, recursive lending and that type of thing. And we realized that there's a lot of risks that people weren't aware of. And we essentially sought out to create a product to mitigate those risks and make it such that institutions can access the strategies while having levers to be able to rebalance their strategies in order to avoid liquidation, for instance, or depegging events, whichever are the main risks in each strategy. So with that, we launched our second product that we call ITB Quant. You can look it up at intotheblock.finance, and it's sort of the easiest way to pitch it is an institutional version of Yearn Finance. It has a wide array of strategies. I think we have over 100 now across multiple chains, and institutions can deploy there. It's non-custodial. There's no commingling of funds. So institutions really like that. And it has with custom risk management parameters that they can set in order to mitigate potential losses. And we've grown that quite significantly over the years. Of course, 2021 was a very good year for that product, attracting large figures from many of the largest institutions. Unfortunately, can't really disclose those institutions. And that product has really taken off. And in 2022, of course, we took a bit of a hit as a lot of our clients lost funds, and some of them were clients that got affected by the downturn themselves. And then in 2023, we started, well, actually in the same 2022, we started seeing the opportunity for risk management as like the key part that DeFi was missing after, so much chaos that happened in 2022. We realized that in order to bring confidence back into the market, the protocols in the space needed to have a bigger focus on risk management. And so therefore, that's how we started the launch for our third product, which we call the Risk Radar, which is essentially a platform to be able to transparently track a lot of the indicators that affect risks in DeFi protocols. I've rambled enough, but I can get deeper into either of those as well as my general opinions in DeFi from my vantage point. I don't know if you have
Nice.
any questions there.
Yeah, I mean, institutional adoption is a word that, you heard people talk about a lot. Uh, when we expect institutions to come in, and if they do, it's a bull market. Um, could you give us an overview, of the market size opportunity for DeFi, and what type of institutions that, we should be expecting to come to DeFi, or are they already involved?
Of course. So yeah, from my personal opinion, you know, I am very bullish DeFi. Of course, DeFi tokens haven't really been the best performing, but I think the underlying infrastructure is definitely more competitive and has a better advantage in many ways from the existing fintech infra, which is seen to be, like something completely different, but it's really like just a UI layer on an app for like banks. That doesn't really unlock any 0 to 1 innovation like DeFi does in terms of being able to transact permissionlessly and in some cases with very low transaction fees, much lower than the ones that the current traditional system takes. So I think over time, and this is like a very lengthy process, and we knew this since the beginning, but in 10, 20 years, I think DeFi will be larger in many ways than the traditional financial system, or at least than the fintech companies right now.
Yeah, do you
And
expect
in
DeFi?
terms, Mhm.
Sorry,
Go ahead, go ahead.
yeah, just because you bring up that you're very bullish long term, right? Do you expect DeFi to do the same, or the functionalities to be the same down the line? What should we expect DeFi to look like in the future? If institutions are coming, what are the use cases? Because like I'm a maker of DeFi degen, right? I farm left and right. Like I guess from my perspective, today DeFi are just mainly providing leverage to degens and creating assets, right? Easily creating any asset on the blockchain so people can easily trade them. Um,
Mhm.
what about you? What do you see the future will shape?
Yeah, I think the degens in a way are essential and like those opportunities to bring some of the like more traditional institutions on chain. We're starting to see some family offices of like, reputable people from the traditional finance world start dipping their toes into DeFi and some of these riskier strategies. It took a bit after Terra for that sentiment to recover, but I think we've seen this in the past 2 quarters, more traditional institutions getting into the space. And I think that, right now, for the next couple of years, we will most likely have a relatively similar infrastructure to where we are at the moment. And a major unlock that's coming further will be as identity can be solved, we can start playing around with under collateralized loans. If you think about it, like all leverage really is over collateralized, but instead of providing physical like capital as collateral, you provide your reputation as collateral. That's how it works in the traditional financial system, and that's why you can get, a mortgage paying only a 10% down payment. That is not possible in crypto at the moment, and it makes it, capital inefficient by default. I think that's one of the major unlocks that are coming. I don't know if it'll come from something like WorldCoin of scanning your eyeballs, or if it'll come from, advanced address tracking that will be able to understand like who you are and how trustworthy you are. But I think once we get that, it'll be a lot faster to bootstrap a company on chain eventually. Um, and you can even think of a lot of the advantages that streaming money and programming it can provide this. So if you are, for instance, paying your mortgage, what if part of your income automatically went, every day as you get your income, actually you can get it every second on chain, that is redirected automatically to repay your loan. That de-risks a lot of the loan opportunity for the other person financing the loan. So I think eventually we trend towards better rates for people and companies borrowing capital as we get identity on chain and a lot of the revenue and income from people move on chain over time. I think we need the high leverage and high yield opportunities now to attract people to start playing around with it. But over time, a lot of those more, organic, so to speak, use cases will develop as well.
As do you think institutions care about the blockchains as well when they do their due diligence? Of course, you know, those institutions will look at the code of the protocols. But what do you think about, the layer ones? You see
Mhm.
roll ups, there's like newer layer ones. How do institutions feel that?
Yeah, institutions definitely do care about the underlying layer one where they're operating. In reality, most trust Bitcoin and Ethereum, and they're starting to get their head around like layer twos and Solana. Honestly, like the vast majority just deploy in Ethereum and like EVM compatible at the moment, just because it's the most battle tested, also the most liquid. Solana, it's grown a lot, but really the capacity, as we call it, like the amount of capital that you can put to work, is not as high as Ethereum mainnet. Actually, Arbitrum is even larger in terms of capacity than Solana. So most institutions are very comfortable with the risks on Ethereum, which frankly has stood the test of time quite well as an underlying network. And I think over time they might get around like the other layer twos, other layer ones aside from Solana as well. But for now, they are quite concerned, with outages and like those sort of risks, especially
Yeah,
for financial applications. So I think it takes time. Right now, it's definitely more retail interest from my vantage point in those chains, whereas Ethereum mainnet has solidified as the main one for institutions, and it's unsurprising also to me that a lot of the more traditional projects like PayPal's USD is launching on Ethereum mainnet and not something like Solana, at least as a starting point. I think 90% of the institutions we're talking with see Ethereum at least as a starting point.
gotcha. Do those institutions participate in DeFi for, I guess, yield farming, or is more than that? Because this follow up to my previous question, right? Because we're starting to see this, um, you know, uh, redeploying the same fort, different newer chains, and those newer chains will get you a really high yield. What type of game do those institutions play, especially in this high rate environment?
Yeah, I mean, there's definitely different types of institutions. I think people generally like put them all in one basket, but they can vary a lot. There are some funds that are, high risk seeking, and those do play like the new fork, but in the new chain playing high incentives. Like, yeah, there's some higher risk funds playing those protocols. But generally, the more risk averse institutions are more keen. They're happy with, rates slightly lower in stable coins, definitely higher than treasuries, but less than 10% is still fine with them. So they're fine deploying on mainnet, on like, paddle tested protocols to get some yield to beat the markets and pass on to, their own LPs or however they're structured. They don't seek, like they actually prefer to wait before to deploy to something new. Even with eigenlayer, like I think we've talked to a lot of institutions about deploying an eigenlayer. And even at 3 billion TVL, a lot of people are still like, I want to wait for this to be more battle tested. It hasn't really launched. So the risk tolerance is a lot lower than the average DGen that will just ape in. Because of course it's like their institutional capital, and oftentimes they work with their own clients, and it's a lot less about earning 50% APY, and it's a lot more about preserving wealth in a way, and also taking advantage. One thing we've seen a lot recently it's taking advantage of their Bitcoin holdings by, being able to add leverage on it while mitigating risk. We essentially automate the liquidation protection by rebalancing from one strategy to the collateral on Wrap Bitcoin on Aave. That's one use case that we're seeing a lot of institutions like as the markets go up, and they suddenly have a lot of capital that they just don't want to sit as this pet rock in Bitcoin that they want to borrow against it.
What type of allocation are we talking about for those institutions? Are those institutions, I guess, like fully like are we focused on crypto and DeFi, or there are institutions that more focused on being a portfolio manager and allocating maybe like 1 or 2% to DeFi? What is the I guess the landscape for today's environment?
Yeah, I mean, most institutions that play around in DeFi already have like at least 10% of their portfolio in crypto. I think the newer institutions that are just starting to do like 1 to 2% into crypto, they are fine just holding Bitcoin. That's already volatile enough for them. So we really work mostly with crypto native institutions or some that have like, transitioned to be more crypto native, crypto oriented. And those, they understand better some of the risks in DeFi. There's still a lot of educational component. Like we essentially go talk to each client about like strategies and like the risks. And sometimes it takes patience for them to understand it for the newer institutions into crypto. And then there's like some very crypto native companies that have their own strategies and are like fully allocated to crypto. Some of them individually are degens, but as a company want to do some like more risk managed strategies and want like to have that automated layer of risk management. So yeah, it really depends on like how involved in crypto you are. The newer institutions are just starting to get a hang of it, and are fine deploying into something like Curve or Aave that has been battle tested and doesn't have impermanent loss risk, for instance.
What are the strategies that these institutions are more interested in? Because there's the whole world of DeFi strategies that you can do to generate this additional yield. You have lending, borrowing to AMMs, of course, with permanent loss, and there's like perps protocols, right? Like GMX, you can deploy, you can buy GLP for taking advantage of their trading fees, and essentially in addition to holding a different portfolio of all those crypto assets. Um,
Mhm.
what's the game that institutions are more interested in right now?
Yeah, definitely can share a bit of alpha here. So they look for mostly market neutral strategies. Most of them start again with very simple strategies, but as they start getting comfortable, they go for something else. Like they'll start with something like Curve or Balancer, where you have yields that are beating the benchmark rates. So you can think of like beating treasuries or beating the staking rate for ETH. And you have a lot of opportunities like with ETH doing still 5, 6% in those protocols, which is, almost twice the staking rate. So that's like the simplest way to get them around. And then they start playing around with more complex. So as you know, DeFi is composable. So one of the cool things is a lot of our strategies can have like multi-protocol integrations. So for instance, leverage staking, there's been a lot of demand for that type of thing where people deposit stake ETH, borrow ETH, and then that's minting more stake ETH in Lido, group supplying it as collateral, borrowing more ETH, and it's all done in a flash loan. So it all happens in one block, which is a significant advantage of doing it programmatically versus doing it manually. We're seeing institutions really like that because it can earn like 3 times the staking yield. And stake ETH, now that it's redeemable, it has been de-risked significantly from their vantage point. So that's one attractive opportunity. And then there's things like what Athena is developing,
Mhm.
which is essentially the funding rate arbitrage. where they
Hmm.
deploy capital. They go long stake ETH and short ETH to earn the funding rate. Those strategies have become increasingly relevant as the market has picked up in Q4.
I'm looking at this chart, right? It's a TVL chart from 2020 to today. Um, in 2021, we started seeing DeFi taking off. The TVL was 15 billion, and the top was about like 10 times that, 164 billion. Dropped all the way back down to 38 billion, and now climbing back to about 50 billion. There are a lot of incidents happen, during the rise and during the fall. Um, what do you think about, the cycle of DeFi, and how has it impacted institutional adoption?
Yeah, I mean, funny that you mentioned the incidents because there's definitely been many, and that affects a lot of the sentiment around crypto, but I think it does so mostly in the short term. We actually have a cool dashboard called DeFi exploits. I can share it with you. And we estimate there's been about $58 billion lost in these incidents, most of which, to be frank, comes from Terra, the 50 billion alone. So that has been the largest by far, and it really, sort of kicked off or exacerbated at least the bear market. Um, and overall, we're seeing that decline over time. Like last quarter, we only quote unquote we saw a billion worth of exploits in 2023. Sorry, not last quarter. And that's the lowest, I think, yeah, 190 million. It's the lowest we've seen in a quarter in a long time, in a year since 2020. So I think overall that's trending lower, and
Mhm.
institutions, it's taken them some time, so at least the ones we talk to, but they can realize that there's a couple of bad grapes in the batch that really made things worse for crypto. Terra, FTX, but they're not necessarily like the blockchain broke. If Ethereum blockchain would have broken and all of DeFi would have gotten lost in Ethereum, that would have been a much worse calamity than Terra, which was already perceived as a very high risk degen blockchain. So I think that is a pattern with market cycles that we see as risk tolerance starts increasing, then capital starts rotating into riskier plays, and people want more yields and higher yields, and it creates that sort of trickling ball that starts growing and leverage expands. And unsurprisingly, as that gets unwound, you see a bit of a credit collapse and capital start being withdrawn rapidly. I honestly think, unfortunately, we'll probably see something similar if we get another bull market, just because that's how human nature operates. Though hopefully, it's less of a percentage of the total DeFi TVL going into something that's that risky. Um, but yeah, we see this, like in the past few months as the market's picking back up, we see a lot of leverage going back into the system. So
Mhm.
I think it's possible that we see a similar pattern play off.
Yeah, I don't want to see another lunar collapse.
Yeah, I don't think anyone does. Um, but but yeah, unfortunately, people get greedy. People start promising higher returns, and they start competing on returns. So that was what was happening, by the way. Like, not many people know this, but a lot of the centralized lending institutions, they were competing on yield, like the Celsius, Genesis, those institutions were like, oh, this guy's offering 10%, then I want to up him up to 12% and 15%, and that's how people start taking more and more risk, and then eventually collapses.
Yeah, I guess that's the nature of finance. Um, what do
Yeah,
you
like
think about, yeah, sorry, okay.
I was gonna say the financial crisis was actually somewhat similar in terms of how that credit started increasing towards mortgages. So it's just funny we had a mini financial crisis with all those centralized lending institutions.
Hey, another argument that I found quite good was also because of the rate hikes, right? It was also at the time of like 2022. This past year we see rate hikes, and
Hmm.
combined with the bear market, people are putting less leverage so that the yield lending protocols like Aave can no longer offer a more attractive yield than even the US Treasuries. And with the recent time back, was it could be attributed to Maker. They started to combining this real world asset, buying this U.S. Treasuries and offering similar like 5% yield. We also see undo finance, and it could be a savior for DeFi because we cannot just hope on token incentives, yield farming all day. At the end of the day, all tokens will run out of emissions, and it's simply unsustainable. What do you think about that perspective?
I think like treasuries on chain. So you got STI, USDM, SFRAX, Ondo. Those are good at creating a floor for yields in DeFi, but they're not necessarily good at attracting, real world capital on chain, at least at scale. Because, the way institutions see it, why would I hold treasuries, with my brokerage that has been fine for 20 years versus putting it into a DeFi protocol? It doesn't make sense for traditional institutions. For crypto natives, it kind of does, especially if you don't have access to, the US American stock exchange and on markets. So some international clients are fine putting their capital there, but it doesn't really unlock that much of traditional capital. And the way why I think it creates a floor is because, right now you get that easy arbitrage opportunity. Not no longer at the moment actually, but when SDI just launched, for instance, in Aave, the borrow rates were lower than what SDI was paying. So that helped increase yields as a whole for all of DeFi. So it made that floor of essentially if the borrow rates are lower than what you get from supplying SDI, then you have that easy arbitrage opportunity. And that got filled really quickly. And then as the markets kicked off, the demand for leverage increased. And therefore, the borrowing rates, like what you get paid from supplying in Aave, has been higher the past few months than from SDI. So I think it's good that it creates a higher floor for people to enter DeFi, and we will most likely see capital rotate from, something like 10% to 5%. So it creates a more narrow range. And there's like some extra incentives that can be applied on these that makes it cheaper for protocols to incentivize. So instead of if you're putting your capital, for instance, into a pool with SDI and a new stablecoin, that is cheaper to incentivize because inherently that half of the pool already earns 5%. So you need to put less capital into incentivizing that. So that's something that a lot of protocols have begun, taking advantage of. Like Curve and CRV USD, they have a lot of pools with SDI, SFRAX, USDM, and those are like, cheaper to get a given level of yield. So in that way, they do provide a bit of an advantage. But I honestly don't think it's the panacea that will suddenly unlock all of traditional finance, as some people make it out to be with, this hype on real world assets.
What do you think is going to be the catalyst for DeFi Summer 2.0 then?
That's a good question. I think it's honestly like people don't like to say it, but I think it's markets turning around. Like we've already seen a glimpse of it. And a lot of DeFi is essentially, financial services, and demand for those services increase as capital increases. So Q4 was already a glimpse of that, where, leverage in Aave increased significantly. I can pull up the numbers for lending protocols, but like the amount of loans outstanding increased like 30% or so. I'm bringing it up 1 second in my monitor. And that's just because people start realizing that wealth effect and borrow more. So in Aave, which of course is the largest protocol, their loans outstanding increased from 4 billion to 7 billion, almost 7, 6.8 in Q4. And that's, most of their loans come from stable coins. So it's actually like new organic demand. They do have some ETH loans as well, but I think that will help off kickstart that new run for at least for capital terms. And newer, I guess we're also seeing in parallel for the retail crowd, coins really bring people, gambling instincts
Yeah.
back into the space. I do think those will stick around for a while. I know they can be controversial. Institutions still haven't gotten around points, by the way. Like I said, told you, they still resist like eigenlayer points, even though they're like the largest and most reputable in a way. And that's an opportunity potentially for retail. And I think probably in the next 6 months, we see even larger point systems attract people. And I think it's a matter of iterations. So I think for retail, I'm bullish in that. But for the more institutional crowd, I think it's just a matter of getting more capital into the ecosystem, and that will flow itself into DeFi.
Yeah. What do institutionals think about DeFi coins? Like, it's just so cheap and it's so awkward in the crypto market, in my opinion, because its users are probably institutions and larger whales. And even though we have like projects like Maker, who the last time I checked, this PE ratio is insane. It's like 16 times, and it's doing buybacks. Aave, its protocol revenue hit an all-time high, but its token is still, let's say, not looking good. What do you think about those existing blue chip DeFi projects and their tokens?
Yeah, like honestly, those are a lot more appealing for traditional finance institutions. Like from those metrics, they look very competitive, and they have arguably a lot of an advantage relative to fintech companies in terms of like the overhead that they have is a lot lower, capital expenses. So I think those are likely to get a boost from the entities that make the switch that into DeFi. It takes some time because of course they start with Bitcoin, then they go to Ethereum, and then DeFi, and then they end up with Maker and Aave. They don't go, straight degen into the newest protocol in Solana. They go for the most reputable ones, and they in a way like that they are priced more rationally in a way. So there's less, I think everyone can agree to this, there's less euphoria around DeFi blue chip tokens. Um, and in a way that's more stable, as long as it's less boring for retail participants, but institutions like boring. So they're completely fine with their tokens not going wild. And it's already crazy enough that, they have loans almost doubling in a quarter. And revenues, that's already massive. They don't need to have like that 10x in growth that some protocols had and these new layer twos. So they prefer that over points for sure. Like when institutions yield farm in Curve, for instance, they see the yield that they're expected to get, and they like that typically they get that, maybe a bit less if CRV prices go down, but they like that it's somewhat stable versus something like points where they don't know how to value what they're farming.
Mhm.
There's a lot of speculation. So often they would go for like the safe 7% APY instead of the potential 25% APY from eigenlayer points or whatever it is.
Yeah. No financial advice, but is there any your favorite different projects that are worth looking at, or you're just like bullish on in general?
Yeah, personally, beyond into the block, I've been liking a lot what Ribbon has been doing. Now Aevo, I guess. Been following them since they launched the initial options product, the option selling product. It was very good during the bear market to have some covered calls there. And now I like their pivot to taking advantage of pre-TGE markets I think I saw that they're doing a lot of bringing a lot of users that way, but still doing more revenue from like perps and options. I think they're like very quick to innovate and they have their own L2. So they've been shown to have like a first mover advantage with that type of infra and like taking those risks. So I think as, you know, realistically, as markets come back up, people want to gamble more in a way, like speculate more. And a lot of those derivatives protocols are, you know, meant to be very successful this quarter, not just Avo. I know DYDX V4 is also doing quite well recently and a couple more. And outside of that, I would say, yeah, like I think Aave has consolidated a lot of the lending liquidity. Compound like hasn't matched up. Even they used to be bigger than Aave, but Aave has really adopted like multi-chain strategy and been like the central liquidity hub across all of it. So I think that one's likely to recover. And we'll see with Uni V4. I know like Jupiter has been giving it some competitions in terms of fully diluted value. But I think with Uni V4, it's a very interesting infrastructure. I think we're going towards what our CEO calls micro primitives, which are like more custom layers within the primitives. So Uni V4 hooks are essentially that, and it allows a lot of customization to happen on top of Uniswap. That's going to bring a lot of cool opportunities, and with lending, Morpho and Order are doing something very similar that I think could be very interesting. Not financial advice on any of that, of course, but I think we're likely to see some resurgence in DeFi, though. Yeah, just candidly, the ecosystem tokens tend to do better, of course.
Yeah, I like able to. Um, Speaking of like perps, right? We started seeing, the collapse of FTX, and that led to a more demand, I guess, on chain, knowing that, you self-custody your funds. Do you
Mhm.
see institutions will start to or have already trading on chain or, using perps on chain?
Yeah, they are. The liquidity has been a bit of an issue because Binance has like 20 times more liquidity than DYDX before, which is the most liquid. But it's catching up. Um, so I think for the next year or so, I wouldn't be surprised if one day we have more volume on DeFi than in traditional finance. I'm saying that for a day. I don't think consistently so, but things are trending in that direction. um, because people are, increasingly confident holding their own keys. It's a bit of a learning curve. But yeah, institutions are playing more and more in DeFi. Arbitrum has had a lot of volume recently, so that's been like the L2 where most institutions gather around, and I think that'll continue.
I'm now going to, I guess, like jump to predictions and, upcoming projects. Um, of course, not financial advice, but we're seeing some interesting, blockchains that, whether they're more focused on, DeFi, like say, like all those like parallelized EVMs, or they're like new type of, proof of stake system like Barrel Chain. Do you have any interested projects that kind of like make you feel like, aha, that is what we're missing in DeFi today?
Um, so I know it's like very new, but I've been looking at it pre-launch. I think like the roll-up play does make a lot of sense for DeFi. I mentioned literally just launched, but other than that, there's Conduit that is like essentially a layer where people can build their own layer twos, and you can make them either app specific or generalized. And I think having your own app specific chain makes sense if you want to do like a perps exchange. Maybe not for lending because lending can be like collaborative with other protocols within the ecosystem. But I think as an infrastructure way, both eigenlayer and things like conduit and dimension enable those rollups to be launched very quickly and also have the underlying safety from Ethereum. So I think those can do very well. Like they enable new use cases, and I think it gives the devs a lot more flexibility in terms of what they control in the stack. They can also decrease costs by outsourcing data availability to Eigenlayer or Celestia. And I think that will make the DeFi applications a lot more competitive to CeFi applications. That was a thing that, in the last cycle we didn't really have. Like, you still have to trade derivatives on synthetics on layer one, or I guess DYDX was already in Starknet, but it was like fully subsidized, and the order book was centralized as well. Now you're getting the decentralized with this infrastructure unlock, as well as Say and Solana, of course. You're getting this infrastructure to compare in terms of like cost and also user experience being on par with centralized counterparts. And that's something that I think will only continue as people start seeing this trend, that there's a lot of builders putting a lot of effort and competing with each other to be able to have like that market leader. So I'm excited for that unlock essentially.
Nice. Do you think there is a preference among institutions regarding type of like liquidity fragmentation? Because you mentioned about dimensions and Solana, there are two different theses, right? One is monolithic and
Okay.
another one is modular. Do institutions care about them? Is there
Um,
preference?
like from my perspective, most people are in the modular camp than in the monolithic, because historically things are like interconnected pieces, and as long as the bridging from one side to the other is somewhat abstracted away, they are fine. Like if you want to tell like an institution that you're bridging from here constantly, then it creates some friction, and the liquidity is also a barrier. But as those movements become easier and that modular infrastructure has become more settled in a way, I think more people are focused on that because it's also more resilient than having like the monolithic approach. I think over time that might change, but right now institutions are more, from my point of view, on the modular thesis than the monolithic. Um, but yeah, I think we'll see how it develops as we continue growing. It will really, put stress on both sides of the equation.
Yeah, that makes sense to me because just a few days ago we experienced another Solana outage, and
Yep.
I have some positions, and I was kind of worried if they couldn't get it back on time and there's a plummet in any of the assets I was borrowing and I could be liquidated. And I think unless that gets fixed, modular being, you can kind of choose your own security preference, that could be internally a better solution for institutions.
Correct. And like in the modular thesis, you can have an L2 or an L3 that goes down, but the core layer, as long as that continues operating, that's usually fine. That's where most of the capital is at anyways. I think it could become an issue if somehow a layer two gets more liquidity than Ethereum mainnet, but I think it'll take some time for us to get there. It could happen, but for now, I don't think that's likely.
Yeah. So outside of that, you mentioned in this cycle or this past few months, the amount of exploits has been significantly reduced compared to the last cycle. What
Mhm.
are the biggest risks that you see are still kind of stopping institutions from actually using it? And where are we today?
Yeah, I mean, uh, with the from my personal experience of talking institutions that are outside of crypto, I think it's mostly a learning curve and like the taboo around it. I think the ETFs help get that taboo, people around that taboo. Like I was literally speaking with a old school banker, and he was saying like, "Oh, I heard they legalized Bitcoin." That's what he said about like the ETF going through, as if it weren't legal before. So a lot of people are like see it as a stamp of approval, and it's a matter of just learning. Of course, the older generations will take longer, but as the newer people in these banks get more power, I think a lot of them see the power in blockchain. And they're like, I think it really doesn't make sense that we have so many counterparties and so many fees. So it's a matter of moving that point from like, it's almost grassroots. Like a lot of my friends that are analysts in banks will help send that message to the people, upstairs. And eventually they start embracing more crypto as they see that value proposition become more clear. But it's not really because they say, DeFi is so risky. I think it's like they haven't taken the time to evaluate the risk in depth. And I think a lot of them will never like adopt it, to be honest. Like I don't see some of the more traditional banks. Well, JP Morgan, it's weird because Jamie Dimon is like criticizing Bitcoin while at the same time they're doing some blockchain things. But I don't think all of the institutions, traditional finance institutions, will adopt crypto, and that's fine. I am more bullish on the existing crypto institutions that will grow to be the size of those traditional finance institutions. I think that's more likely with any new technology, that a lot of the startups end up surpassing incumbents as the market size explodes. So that's also why I'm bullish DeFi, because I think a lot of these early platforms can be like the new um, JP Morgans of the world.
Yeah, that makes sense. Lucas, it's been a pleasure. Your insights today have been incredibly valuable for understanding the institutional landscape of DeFi. For those of you, for those of the audience who would like to know more, where can people find you?
Awesome. Yeah, they can check me out on Twitter at Lucas Otomuro. I can send it as well as into the blog. I'm not super active on Twitter. But yeah, I guess we're doing a lot of effort in the platform, launching a lot of the dashboards with the data that we discussed on DeFi. So if they just check out app.intotheblog.com, that's also you'll see a lot of the info that I was discussing. And we're consistently doubling down on DeFi. So if you're interested in the space, we have a lot of things planned for this year. So it's cool. Thank you for having me, Sheng. It's been
Yeah, thank you
fun.
for joining us.
Of course. Have a good day, and I guess we'll talk later. See
Yeah,
ya.
hopefully we can do a V2 when DeFi Summer 2.0 comes.
I'm down. Hopefully not too soon, not too far away.
Yeah. All right, have a good one.
All
Thanks.
right. Thank you.